Just a quick update with regards to rates and mortgage strategies at this point in time. Over the past few weeks, we've had a shift in rates, in the short-term rates and long-term rates, and also the forecast for the prime rate. So just a quick update here is our strategies are shifting right now on what we're recommending to clients, and we're just going to give you a quick update here on where we sit at this point in time. So we're looking at the 2-year bond yields right here, and this is back when the prime rate decided to hold still, and they did not have any increases or decreases, of course, is that, and then also the collapse of the Silicon Valley Bank is that we've seen quite a large plummet in bond yields, which means these directly affect the fixed rates, and they've gone down by about 0.6%. They're staying down there. So what we're seeing is a lot of the 2-year fixed rates and even the 5-year fixed rates, they began to decrease. So the forecast has shifted on what we're recommending or suggesting to clients. So we jump over here and we compare products side by side. I'm going to do a 2-year fixed here, a 5-year fixed, and a 5-year variable. And what I'm going to do is I'm going to compare these just over the next 2 years. And the strategy being is that we're suggesting or recommending to our clients is to look at a shorter term because we are anticipating rates to be lower in the next couple of years. So if we look at a current 2-year fixed at 5.25, and then we see a 5-year fixed at 4.84, and then a variable at prime plus 0.55. And what we've allowed here is prime rate decreases. This is something that we're just forecasting, and we're ad hocing this right now. This could change on a daily or even a monthly basis. As we're looking at a quarter point increase, decrease in 10 months, quarter point decrease in 13, and then 17 and 24 months. So how that looks overall over the next 2 years is that the 5.25 compared to 4.84, of course, we're going to save a little bit of money. So the payments are going to be about $1,053 lower based on a rate of 4.84 to 5.25. We're going to pay off our mortgage about $288 less, and the total interest is about $1,342. But the challenge we have here is that if the rates drop, which they're expected to in the next couple of years, down to like 4 to 4.5 or whatever, then of course this isn't. It's not as good of an investment with regards to a mortgage rate because we're going to have to pay a penalty and lower the rate and so forth. So once we jump over here is that looking at a variable is that because the prime rate is supposed to stay high for a little bit, what's going to happen here is over the next 2 years is that it's going to cost us quite a bit more money to hold that variable and that. So right now we're recommending going with a shorter term rate just because of the forecasting and so forth. And we don't want to be locked in for a long period of time. Hopefully that helps. If you have any questions, don't hesitate to reach out. Thanks.